let's do non-monetary transactions. I'm on page 181 in your book or in your notes. Then we'll take a break. Okay, we'll do this one, and then we'll watch more, and then we'll take a break. And then we'll have 2 left after the break. Okay, non-monetary transactions. Under ASPE, we have 1 section. But under IFRS, there's no specific section. It falls into 5 sections. Now, people, depending on when you got your binder, you may have something that is not updated. It's not a big deal, okay? It's more formatting than anything. But the 5 sections, one of the 5 sections is the revenue section, which is now IFRS 15. Many of you probably have your notes that will say IAS 18. That's the old revenue section. You guys are responsible in 2018, you're responsible for revenue from contracts with customers, the IFRS number 15. So the good news is the actual accounting for non-monetary in the revenue section has not really changed. It's really more of a formatting change that I did in the notes. You can make the changes you're watching the slides on your own paper if you want. It doesn't really matter. The big thing is the actual accounting is basically the same. But IFRS sticks non-monetary into 5 different sections. So we're going to cover ASPE. And then if there's a difference, I'm going to highlight it. Any questions? Now, people, I think you should know, I think it's fair for me to say you should really know your definition of what is a non-monetary asset and liability. Okay, I mean, that doesn't tell you much. It means they're not monetary. Okay, that's nice. We're going circular here. I would always think foreign currency. It's the same definition. In foreign currency, you have to know what's a non-monetary, what's a monetary item. Does anybody know the definition? What is the definition of non-monetary, or give me monetary, and we'll take the opposite for non-monetary. Anyone know the definition? Okay, I'm just testing to see if you can read off the screen. People, here's your definition. Right, Gavnita. I'll tell you what people always think. People always think monetary means that it has to be in cash, which is obviously monetary. No, it has to be convertible to cash, fixed or determinable, and the value's not going to change. And see, someone say, okay, no, there does not have to be any cash involved whatsoever. Accounts payable, accounts receivable, those are monetary items. Non-monetary items, what we're going to be dealing with, are things like inventory, capital assets, things that fluctuate in value. I don't know how much my inventory is worth tomorrow or the next day exactly. That value can fluctuate. Okay, so this is the identical definition to that in the foreign currency section. Fine. All right, easy. Okay, without consideration, okay, nothing. Okay, now, here's the general rule. This is ASPE. If both the item given up and received can be equally reliably determined, then you're supposed to use the fair value. You're supposed to use the fair value of the item given up. That's how you measure the asset received. I use the fair value of the asset given up. Okay. What happens if I don't know the fair value of the asset given up? Well, if you don't know that, then use the asset received, the fair value. Okay. Now, people, that is ASPE. Under IFRS, the rule is the same except for the revenue section. The revenue section takes the opposite. You value it at the fair value of the goods received. Okay? And if you don't know the fair value, then look to the selling price of the asset received. That's the major difference. So it's a significant difference. It's the opposite accounting. And it's an important section because it's IFRS revenue. Now, when does something fall into that section? You know when it falls into that section? If it does not fall into the other 4 IFRS sections, it falls into IFRS 15. That's when it falls in. Okay? All right, any questions? Simple example. Let's use fair value. Okay, fine. So company A provides 10 computers. Oh, someone said, yeah, no, I know, I'm sorry, I know that. Okay, Ron is saying to me, yeah, people is saying that the book shows IAS 18. Yes, people, that should all be corrected in your book. It just means that when you got the book, we hadn't yet updated that. It was a mistake on our part. We should have, but it should be IFRS 15, not IAS 18. IAS 18 is the old one. Okay, IFRS 15 is the new revenue contracts. Okay, that's the new lengthy section in IFRS. This is only an IFRS thing. All right, example. Company A provides 10 computers to Company B in exchange for 10 desks. Okay, good. Is it non-monetary? Absolutely. Computers for desks. Those are non-monetary assets. I don't know the value tomorrow. Okay, look at the values in front of you. What are the entries? Okay, well, the entries are, I get Company A is going to debit the desks 9,800. Why? Why 9,800? They got computers in exchange for desks. So what they're going to do is they're going to take the fair value. They're going to take the fair value of the asset received. Okay. What did I just say? Did I just get this wrong? Yeah, I just got this wrong. Sorry. Okay. Sorry. Let me get rid of that. Okay, goodbye. They're going to take the fair value of the compute. They're going to take the 9,800. That is the fair value of the computer, because we just said that you're supposed to take the fair value of the item given up. What'd they give up? Company A provides 10 computers. Okay, good. What's the fair value of the computers? 9,800. So they're going to value the desks at 9,800. That's what they got. Okay, they value the desks. The computers, okay, they credit 6,000. That's easy. Where's 6,000 from? 6,000 is, that's a carrying value. Fine. And the difference is our gain. Okay. Therefore, they would debit the fair value of the desks. Correct. Navneeta's saying that Company A, right, gets desks. Therefore, they would debit the fair value. Well, no, Navneeta, I think you got it wrong here. Okay, sorry, people, let me respond to this. Navneeta, you're saying they will debit the fair value of the desks. No, the fair value of the computers is 9,800. The fair value of the desks is 10,000. They are not using the 10,000. They are using the fair value of the asset they gave up. The fair value of the computers. Okay. I don't know why I'm just doing this. Okay. The fair value of the computers is 9,800. Okay, forget that. Okay, but anyway, I don't know. You know, my marker is very difficult to use. Anyway, okay, the fair value of the computers is that. Okay, right. You meant computer. Good. Okay, a DT question here. 1 sec. Fair value computers are part of the computer. Exactly. Right. People, this is ASPE. Okay, fine. This is all ASPE. I'd write it, but it took me a year to write it. Okay, Company B does the opposite. They gave up desks. What's the fair value of the desks? 10,000. So they valued the computers 10,000. They got rid of the desks. The carrying value is 5, and they have a gain of 5. Okay. Now, what if it's under IFRS 15? What if it's under IFRS 15? I use the fair value of the item received. Well, the fair value of the desk was 10,000. So they debit desks. Company A got desks. They got rid of computers at 6. And now the gain is 4. The numbers are different. Company B, 9,800. That's what they got. That's the fair value. Okay. In all other IFRS sections, you would use the fair value of the asset given up. It's only in the revenue IFRS 15 where you use the fair value of the asset received. Is everybody good so far? All right, now, people look. We have a number of exceptions to the use of fair value. And you have to go through all 4 exceptions, because if one of them is here, I do not use fair value, I use carrying value. What are the exceptions? A, the transaction lacks commercial substance. I'll define in a minute. B, it's basically you're exchanging property, a product in the same line of business to facilitate a sale other than the parties to the exchange. And you can see the example. You gave up blue widgets for red widgets because one client, I don't know, wants red widgets. They're both widgets. Therefore, I would use carrying value. Okay. C is obvious. What happens if I don't know the fair value of both what I received or what I gave up? We said before, you use the fair value of what you gave up. If you don't know that, use the fair value of what you received. Now I'm saying, what if I don't know both? The answer is C. I use carrying value. And D, that one doesn't usually come up. Basically, if you're in type of some spin-off or restructuring or liquidation, then you would use carrying value. One little thing, people, which you don't have in your notes because I added it on, and most people are not going to have this. You have something else which I got rid of, is condition B, where you have a product for a similar product. That is not even in the scope of the IFRS 15 revenue. Okay, so that point is not even in the section for IFRS 15. Okay. All right. Go back to the first one, the first exception. What is commercial substance? Commercial substance, 4 things, you need one of them. The cash flows of what you gave up from what you received are going to be different either based on risk, based on timing, based on amount of the asset given up versus the asset received. It's a very broad definition. The cash flows are going to be different. Something is going to be different here between what I gave up and what I received. But it doesn't actually have to be the amount. Look at that's number 3. It could be the risk or the timing. And there's a 4th one. And I'll give an example for the 4th one. What is going on? Okay, people, just 1 sec. Sorry. There you go. Okay, the 4th one was a little scary. Wasn't changing. The 4th one is the entity-specific value. Let me give you an example. Okay. One company, it's kind of this example. One company owns an apartment building in Toronto and in Montreal, Company A. Company B owns an apartment building in Montreal, and it happens to be next door to Company A's apartment building. 2 apartment buildings side by side. Company A says to Company B, you know what? I'd rather have 2 buildings in Montreal, side by side. I can get economies of scale. How about I give you a building in Toronto that I own, and you give me your building in Montreal that happens to be beside my other building? That sounds like you're doing the same asset. That sounds like I'd use carrying value. But we call that the entity-specific value. You're going to have a big win in Montreal. Now you can use the same maintenance staff. You can lower your cash flows down the road. Therefore, that is the entity-specific value. And that constitutes commercial substance. Now remember, people, don't get this confused. It's a little weird. If I have commercial substance, I don't meet the exception. I use fair value. If I don't have commercial substance, I do meet the exception. I use carrying value. Okay? All right, so any of those 4 constitute commercial substance. It's a fairly low bar. It is a broad category, commercial substance. All right, any questions? Everyone good so far? Now, this came up in a case a number of years ago. People had a hard time with this. I'll show you where they goofed. Let's talk about how do we account when we're not using fair value. I already gave you an example when we use fair value. Just go back in the notes. You got gains or losses on the income statement typically. Here's my question before I even show you this. What's your gut feel? Okay, Monica's asking the question. Very good. Do you think we're going to have a gain or loss when we use carrying value? What is your sense? What is your gut feel? I agree. A number of you are saying, no, I kind of agree with you. That should be, I think, the starting point. Why would I have a gain or loss when I'm using carrying value? Fair value, for sure. But carrying value, probably not. All right. Now, one more question. Am I allowed to have a non-monetary transaction and also exchange some cash along with the assets? Does cash throw off the whole section and I'm not in non-monetary anymore? Because now we have cash, which is monetary. My question is, am I allowed to have some cash? Yes or no? Okay, everyone's saying yes, and you're all correct. The answer is yes. It has to probably be a small amount, but it's not really defined in the handbook, so don't ask me how small. Okay. So, yeah, Aditi's saying non-monetary has to be the majority. Yeah, I don't know. To be honest, I don't know the cutoff. I don't even know what the real cutoff is. All right. With those points in mind, number one, if you have no cash involved and you're only using carrying value, you probably would not have a gain or a loss. We just kind of said that, and that's number one. Number two, if there is cash involved, okay, there is cash involved. Usually, there's no gain recognized, even if there is cash involved, because you're recording everything at carrying value. However, there is a situation, I'm going to show you after, there is a situation where you could have a gain or a loss when doing carrying value. But I just want to point out that, this is not the norm. What happened in a case a number of years ago is that half the country made a mistake and started talking about gains and losses when they were in the middle of a non-monetary transaction that should have been a carrying value. And they knew the carrying value. That was not the problem. They knew the criteria. They knew that it met the definition, whatever, of carrying value. But then they started talking about gains or losses, and it made no sense. I don't even think there was any cash changing hands. So I don't know why people started to do this. And the Board of Examiners was very critical, and they didn't understand what people were doing. That's why I started off. What's your sense? Why the heck would I start talking about gains or losses? It's weird when I'm dealing with carrying value. Okay, so just to show you a quick example, Company A provides 10 computers to Company B in exchange for 10 desks. Okay, fine. Let's assume we don't know the fair value of either item, so we have no choice. That was point C. I meet the exception. I have to use carrying value. All right, fine. Everybody see it? The computers are 6. Okay, so the computers are 6. Company A, I value it, right? I value it. I get rid of my computers at 6, and I value the desks at 6. No gain or loss. Company B is 5 and 5. No gain or loss. We're all doing carrying value. What if I throw in $200 of cash? 10 computers in exchange for 10 desks, plus 200. Okay, again, same as last example. Why am I doing carrying value? I don't know the fair value of either. All right, again, 6 and 5, computers and desks. Now it's a little different. Now, Company A, they credit the computers for 6. They credit the cash for 200. They paid $200 cash. Okay, fine. The desks, I never find someone 2 of them. the desks go up in value. Not 6,000, but 6,200. But I still don't see a gain. There's no gain. Company B does the opposite. They gave, okay, this should be over here, right? They gave cash of they got cash of $200, so they debit cash. They take it off the computers. They credit the computers $200. Okay, fine. So 5,000 minus 200, it's 4,800. And they credit the desks. No gain again. So, people, what I'm saying is that in your normal situation, when you're dealing with carrying value, I don't expect to have a gain or a loss, even if I have some cash. Now, it is possible. I don't have an example, but I just want to tell you it is possible to have a gain or loss. How do I have a gain or loss? Well, okay. Sorry, in scenario one, sorry, before I answer the question, I have a question here. In scenario one, same treatment in IFRS. In scenario one, it would be the same treatment in IFRS. It would be at the carrying value. Yes. Yeah. Now, here's the exception. Here's the exception. You know how you could have a gain or a loss? What if company B got cash of like $5,000? Or actually, no, let's take $6,000. How would they do that? Company B received cash of $6,000. What are they going to do? Debit cash $6,000. They can only credit the desks for $5,000. What are they going to do? That $1,000. It's not going to go to computers. The computers are supposed to be, I don't know, the computers are 5,000 minus 6,000. What the heck does that mean? You're going to have negative computers? Kind of negative asset. So the answer is that would produce a loss. That would produce a loss. Now, that's weird. That's extremely weird. What it would mean is that the computers would not show on their books because the cash was so much. The computers would not show on their books. Now, before you tell me that that's impossible, it's not really impossible. We have nonprofit organizations where people contribute assets, and because they didn't pay for them, they don't record the asset. It's not on their books, but they own it. We have situations where we have an asset, it depreciated down to zero. And it's sitting now in my warehouse. I'm keeping the asset. It's no longer on the books. It went down to zero. I'm just saying we do have examples where we could own assets and they're not on the books. Second point, some people say to me, how could you have so much cash involved? Maybe the whole transaction is no longer non-monetary. Well, I'll give you a way. What if the fair value of the asset was way higher? In relation to the carrying value, the cash is significant. But in relation to the fair value, no, the cash is not that much. So in other words, you could still have a non-monetary transaction with cash that looks really big. But when you compare it to the fair value, it's not so big. And that's, but people, this is an exception. I don't have an example with this. I don't want to even have an example with this because it doesn't happen very often. When you do carrying value, I don't usually worry about gains or losses unless I have a weird situation where I'm giving up so much cash or receiving so much cash that it throws off the whole transaction. A few questions let me just deal with here. IFRS 15 is not changing the accounting. What I changed in your notes was I just corrected the fact where it said IAS 18, I corrected it to IFRS 15. It does not really change the accounting. We still measure it if it falls into the IFRS section at the fair value of the asset received. IFRS added a tiny point. If you don't know the fair value, look at the selling price. Yeah, okay, fine, big deal. But it's basically the same accounting under IFRS 15 as it was under IAS 18. I just updated my notes to reflect the IFRS 15. Okay. Maintaining the fixed asset. Okay, register. Okay, fine. Oh, Navneeta wants to know, do I book it in our register at zero value if you wiped out the asset? I mean, would you book in your register? Probably not. I mean, it's not going to be on your balance sheet. Let's put it that way. I don't really care what you do internally. It's not going to be in your balance sheet. You're not going to show it at zero. Now, the truth is, I will say one thing, and now I'm guessing a little bit here, but there is a concept where if you want to show you have an asset, you show an asset at $1. They call that a nominal amount because you want to show the users you have the asset. You do not have to do that. But I've seen in real life, I've seen some companies do that and it looks really strange on the balance sheet. You got an asset for $1. You could disclose it, but you want to show people you have the asset on the face of the balance sheet. Oh, so Navneeta, the answer Navneeta's asking in my example of cash, if cash was $6,000 and you would credit the desk for $5, you credit the desk for $5, debit cash for $6, you'd have a gain of $1,000. You'd have a gain of $1,000. It sounds crazy, but it's like you got so much cash. What's really strange is not so much the gain, although I keep saying the gain is also strange because you're using carrying value. What's strange is that the asset is not on your books and you've got computers. That's what's weird. But that's why I tried to give you a couple of other examples where this happens in real life. Okay, we'll record gain. So Aditi's asking, in IFRS 15, we have to consider carrying value, receiving item, and if carrying value receiving is less, then we'll record gain. That's correct. Yeah, but again, people, I'm going to say this is an exception. Don't get hung up by this exception. Do you guys realize where people had problems in the actual, I think it was in the UFI question, there was no cash even changing hands. It was just an asset for an asset. And people started talking about gains and losses. So just be careful. I'm saying it's weird to have so much cash involved that it's wiping out your carrying value. That's what produces a gain or loss. And I'm just saying it could happen. It's unusual. Okay. Well, I think that is basically it. Restructuring or liquidation. Okay, fine. Okay, government grants, whatever. Okay, it's nothing here. I don't know. Basically, there's some little thing for government grants, presentation and disclosure, not very big. Okay, fine. Now, I have to say one other thing, which I'm not sure if you guys have in your notes. Do you guys have something in your notes about advertising? I don't recall if that's in there or not. Do you have another section about advertising, number 31, I think? Am I right? Is it yeah, SIC 31? Okay, people, put a big X in front of that. You don't need to know that. Everyone with me? You have one, it's either 1 or 2 pages in your notes. I believe it's SIC 31. Okay, it says page 193. Thank you, Arun. Okay, Navneeta says page 189. Okay, I don't know what the page number is. Okay, it might be different in some of the books, but basically you have something at the end of the non-monetary section. Okay, and it says SIC 31. That has been replaced. It's gone because of IFRS 15. Okay, whatever was in there is now sitting in the revenue rec section. Is now sitting in the revenue rec section in IFRS 15. So just get rid of that. Just put a line through the whole page. You don't need to know that. Sorry about that. Okay, you don't need to know it. Okay, it's not even in my PowerPoint presentation. All right. So non-monetary transactions. Oh, somebody said IFRS 17. Yeah, that you need to know. People, there may be another one there which I don't cover here because it's very specific. I don't have it in my PowerPoint, but yes, I'm only telling you to remove that one page, okay, or 2 pages for the SIC 31. Okay, if you got IFRS 17, yes, you need to know that. It's minor. That's why I'm not covering it. It's minor. All right. So look, non-monetary is a good one. It's come up over the years. I don't think it's that difficult. I don't think the technical is so bad. The main things with non-monetary are, number 1, you identify it's a non-monetary transaction. Number 2, You know the basic rules of how to account. If it's IFRS, which section it goes into. If it's ASPE, okay, then it goes into really just a one section. It's going to be based on the asset given up. Number 3, you'll have to look at those criteria for carrying value, because all you have to do is meet one of them and you're into carrying value. And don't get hung up on the gains or losses. If the whole thing is carrying value, there's no cash involved, forget the gains or losses. But if there is some cash involved, you got to look at how much cash there is involved. That's all. And what the asset would be on your balance sheet, assuming the cash is not so great that it wipes out the asset. That's basically it for non-monetary. Questions? All right. So people, let me turn off the recording. That concludes the non-monetary. That concludes the non-monetary section. Hope everybody enjoyed non-monetary.